Hello everyone. Today we will be doing the subject economics and we will be doing the topic money and banking. So we'll cover understanding money, central and commercial banks. So first we have to know that before money was a thing, before currency was there, people used to use something called the barter system. So this was a system where people would exchange goods for goods, services for services, like kids sometimes do because kids don't have money. So they're like, give me one chips for one chips, or like give me lollipop and I'll give you chips, like that. So this was a problem because it lacked double coincidence of wants. So for example, someone wants something else, but you don't have that thing and you want what they have. So then you can't exchange, right? And also, like, it's not divisible, so you can't really divide your goods and give it separately for its value. And that's another problem, measuring of its value. So like there wasn't a fixed measure of the value. Like no one could say like, oh, 10 for example, 2 bags of rice, will it equal to 5 cans of oil or no? Like there was that problem too. And there was a problem in storing it because like sometimes for example, farmers, their whole livelihood is fruits and vegetables, and like they can't really store it forever. Back in the day, like it would perish. So that was also another problem because once their goods ran out, they couldn't exchange anymore. So that's where money came into existence. So money is a widely accepted medium of exchange for goods and services. So it doesn't only include like banknotes. Back in the day, it was coins too and gold. And nowadays, due to the rise of technology, electronic deposits like NFTs and Bitcoin are rising too. So the whole function of money is four. It has four main functions. So the first one is store of value. This is very simple to understand. It basically like holds its value over time. So one dirham before is the same value as 1 dirham now, but this can be affected by inflation, obviously. And then next we have medium of exchange. So medium of exchange means that you can go out anywhere with 1 dirham and they'll accept it. Like they'll accept the currency, they'll accept the money. Or if people don't accept your money, then your money is basically useless. Then it's standard of deferred payment. So this means that you can like arrange terms of credit like loans, or you can like settle future debts with it. And then finally, unit of account. So unit of account just means that it gives value to different like objects. For example, goods, sorry. So a pen is like 5 dirhams and a notebook is maybe 15, like that. So now we have the characteristics of money. So the characteristics of money is what makes money widely acceptable, and it what makes it efficient. So it's acceptable everywhere. It's portable, like you can carry it, either credit card or just cash in your wallet. It's divisible, so you give 10 dirhams, buy something for 5 dirhams, you get 5 dirhams back. It's uniformity, which means everyone agrees to it. There's scarcity, so this is based on the government actually. But it's always going to be scarce for it to have value, and it's durable. So over time, as I said, the value of 1 dirham is 1 dirham. So now we have central banks. So central banks are the main financial institution of a country. So every country in the world will have one main central bank. So it's this bank controls your monetary policy, how much money is supplied, and the interest rates. So it's this central bank, it's very important in economics. So the role of central bank is lender of last resort. So this means that when even commercial banks, when they run out of money and they're about to go bankrupt, they go to the central bank. So that's what we call lender of last resort, because it only lends loans to either very big companies or to like commercial banks. So as I said, it also runs the monetary policy, which controls money supply and interest rates. It regulates the banking industry. Like as I said, you can't have too much money or the value of your money will be down, but you can't have too less money or inflation will be high. And it's the government's bank, so that's obvious. But the government assigns like a different person in charge of a bank that's external to the government, so there's no corruption, though some countries don't do that. Now we have commercial banks. So they're financial institutions that offer banking services to individuals, businesses, and governments. So for example, when I transfer money from my card to Alicia Yan's, the central bank isn't going to deal with it because they have a lot of other stuff going on. So these commercial banks, that's what they do. They can also accept deposits, they lend to customers, so their point is making a profit. Central banks don't want to make profit, but they want to make profit. So that's why they also usually send loans. They offer foreign exchange services. They provide financial advice, and it's a medium of payment, basically. So the importance of commercial banks is that they support and encourage saving. Obviously, you can have a savings account. And by giving loans to smaller businesses, they support business growth, and even sometimes they themselves, the banks, invest in many businesses. So they give economic stability because, as I said, they give out loans to many people, and that leads to higher spending, and higher spending equals more demand. More demand means that increased productivity. It's also convenient for us consumers and for the central bank because it takes on responsibility for a lot of individuals like citizens, and facility trade. So that was it for today's video. Thank you guys for watching.